Good morning. Welcome to the investment meeting of the Teachers Retirement Board for June 2nd, 2022. I'll start by calling the roll. Thomas Brown.
Here. Good morning, Patricia.
Russell Buckley.
Good morning, Patricia. I'm here.
Good morning. Suman Ray, excuse me.
Good morning. I'm here, Shuman.
Thank you. Allison Hirsch, here. David Kazansky.
Present.
Deborah Penny.
Here.
We have a quorum. Turn it over to the chair.
Good morning, everyone. We are going to start with Passport Funds first quarter 2022 performance review. And we go to Robin.
Thank you. So if we have already reviewed March results, but perhaps if we could just go to this quarterly performance report. Thank you. And flip forward a little bit to slide, I think it's slide 3, which has the capital market performance. This is March. I just wanted to refresh everyone's memory as if anyone wasn't not aware of this already. But on this chart, what we're showing is performance over the first quarter. So those are the green bars, the 1-year period ending with March 31st, and then we chose 5 years. And so you can see that this is as of March, and we'll be talking about both April and May in a few minutes. But as of March, you can see that the major equity markets, US equity market and the world equity capital markets were positive still for the 1 and 5 year periods, despite losses in about the 5 to 6% range for the first quarter. You can see that's true except for emerging markets, which were down 7% in the first quarter, and for the 1 year period, down about 11%. The other thing that is striking about the first quarter, not only the negative returns in equity markets, but also the lack of diversification offered by fixed income to those losses that we saw in equity markets. So if you look at the right-hand side of this slide, you'll see performance for the US Aggregate Bond Index, which was down 6% for the first quarter, and for the 1 year period down a little over 4%. Still slightly positive for 5 years, but for the first time in a long time, we're seeing that there is no shelter from the storm in the fixed income markets. We witnessed in the first quarter some widening of spreads as well as rising rates, and so those both combine to lead to negative returns in the fixed income markets. And I know that that's probably a theme that Mike will talk about in his report on the pension fund, but it's an important theme, and I think is an important aspect of the current market volatility to remember when we talk about other strategies that we're trying to invest in, particularly in the pension. So with that, we can, I could discuss first quarter returns for the individual funds, but we've already talked about them in prior meetings. So I think we might better use the time to talk about what happened in April, if that's acceptable to the board. Sure. Yep. Okay. So that will conclude my remarks for the first quarter. And Devin Alexander will comment on April and May.
Sure. For the month of April, we saw the diversified equity fund down by just over 8.5%. Leading the pack there was the active managed US equity composite, down by just over 10%. On a relative basis, the international equity composite was slightly better performer, down by only 6.5% for the month. Moving down to the balanced fund, down by 3.4%. International equity, on a relative basis, international equity index fund was actually slightly stronger, down by 6%, just over 6% for the month as well. We did see some lag here on the US side. US equity was down by almost 9% at 8.79% for the month. And on the sustainable side as well, we did see some challenges for the month. We saw the sustainable equity fund down by 12.9% for the month.
I think it's worth noting that because of the losses during April, we now see the year-to-date, the one-year performance as negative for the diversified equity fund, as well as for a number of the other variable funds. So the balance, in fact, all of the variable funds for the one-year period are now negative.
And are there any questions on April? Moving over to the preliminary results for the month of month of May. On the bright side, they're all zeros, which is which could be a good signifier, that's indication that perhaps this may be the end and maybe an upswing there. We saw some, to highlight the page, we saw some relatively strong performance from Brown Advisory. They were up by almost 0.5% for the month. On the international side as well, we saw that the Fidelity Total International Index Fund was up by just over 1.5% for the month. But for the most part, everything was pretty flat across the board. But I think that would be a good indication if you compare that to calendar year to date, which we saw negative all throughout. Zero is not so bad after all.
Thanks for cheering us up.
Cute.
So that's really the story for May. Flat performance, slightly positive in non-US equity markets from a dollar-based investor perspective, and slightly better in the fixed income markets.
Thanks. Any questions for Robin or Devin? Okay, so then we're up to the public agenda for the pension fund. We start with the quarterly fund performance overview.
Good morning.
We're on deck. I hope we do a little bit better.
I unfortunately, Robin has given me the burden of sharing some of the bad news. So can we, Kate, get our slides up, please? Great. Next slide, please. So just to kind of set the table what we're doing, we're going through our normal Q1 review with myself and then Dan doing some risk analytics about it, some forward-looking concerns in the market, which are kind of similar to what we've experienced. Then we're going to show you some snapshots as to more current stuff. And deep dives today is all about fixed income. So you're going to have Robert Fang doing public fixed income and Tina Sue doing alternative credit. So normally you'll find my remarks all sorts of fixed income stuff in it, and I'm trying to limit those because they're really going to harp on the themes both within their asset classes and within your managers. And then we'll go into our investment recommendations. So with that being said, let's.
Can I just jump in for a second to remind us that the first part of your presentation will be in public,
Yes.
and then we'll have to move into exec for the
Thank you.
deep dives and the audit.
And the more timely information. Thank you. Next slide, please. So we've talked about the poor returns in both fixed income and equities. So I'm not going to, I'll go into some rationale before that, but a couple takeaways from the slide that I wanted to call your attention to. So when you look at the first row, public US equities, terrible performance in Q1, strong performance in the longer time periods. And importantly, I just want to remind everyone again that the last column is the weighted average of the 5 consultants return. So not just Rokitans, but the 5. And the point of that is just to show the massive outperformance by US equities over some longer time periods. Key question that we all face, is that going to continue or is it going to mean revert? So we're going to come back to that theme a few times. The other thing I want to point out, in fixed income, the long duration stuff, rising rates had a terrible quarter. But interestingly, in a risk-off environment, the credit stuff, investment grade and high yield, the negative returns there are from the movement in interest rates, not from spread widenings. And again, that theme kind of gets into, are we going into a recession or hard landing? In previous cycles, we've seen credit be a canary in the coal mine. That's not happening today. So you see those negative returns. And just a reminder, those come from the move in rates, not from spread widening. Next slide, please. As this feels like ancient history, the narrative around this is really a rise of inflation, central bank hikes, a few key things on this slide I just pointed out. And then in that third bullet, rate hikes in other countries as well. So this isn't just a US phenomenon. Virtually every central bank in the world other than Japan and China are raising rates. And again, Robert has a great slide on the magnitude of that across a bunch of different markets. And then, as we all know, the exogenous events of Russia invading Ukraine and China's zero COVID policy have added to the inflationary pressures that we're feeling in the economy. Next slide, please. Robert's going to talk about some of the fixed income declines, so I want to focus on some of the equity stuff. So we're labeling this correction from historically expensive valuations. And I think, you know, Robin and I both felt like broken records talking about historically expensive, and then boom, it's happened. And what we're showing here is the contraction in the forward PE ratios for both the S&P 500 and the NASDAQ. And again, if you go back to the beginning of the year, the forward PEs were the most expensive they had been other than pre-NASDAQ crash. So we started at an expensive place and we are on the way down. And again, the big question is, are we going to hold in this kind of levels, or is there more damage to come? And obviously we don't know the answer to that, but what we're trying to show you here is this has really been not about earnings growth slowing, it's about rising yields, which bring down PE ratios because of the change in the discount method. Next slide, please. So this is the Goldman Unprofitable Tech Index. And as you can see, the starting point in the beginning of the pandemic to its peak, it went up almost 450%. So a huge rally. It is now crashed. It is down almost 75% from peak. What names are in there? Think Zoom, think Peloton, Teladoc, CrowdStrike, a lot of these firms that had multiple billion-dollar valuations with negative earnings. And that correction is, not even a correction, that collapse is underway. And, you know, it is what it is. It's really that growth equity and venture. That's great run up, and now it's come back down to earth. Next slide, please. You know, they're riding now, but the growth rate changed. And the stock got valued on the growth rate during the pandemic. So whatever the growth rate was like this, it went like this. And the equity investors valued this ad infinitum. And then the growth rate slowed. And then this is an attempt to frame the historical nature of Q1 and how unusual it was. So a histogram, and across the horizontal axis, we're showing quarterly returns for an index 60% equity, 40% bond portfolio. And if you can read it, it goes from minus 12% on the left to plus 17% on the right. On the vertical scale, it's the frequency of those occurrences. This is going back 46 years. So where was Q1 in the history of 46 years? You see the dark bar. You never want to be on the left tail, you want to be on the right tail of these things. And in terms of percentiles over the last 46 years, it was in the 8th percentile of return. So it really was a terrible quarter historically. Next slide. I think this goes over to, is it still me? I can't remember. Oh, I'm sorry. So those are the public markets. Now your portfolio, how did the teacher's portfolio do in your specific asset classes? I'm going to come back to this in the excess returns, but in the top two rows, US equity and world ex-US, you underperformed the benchmark. So we're going to go into great detail on that. In high yield, you outperformed the benchmark, and Tina's going to cover that. So I'm not going to touch that one. Next slide. Here comes some good news. So the private markets, and so a couple caveats here. So first of all, we're showing 1-year returns, so not 3 months. And we really want to get in the habit about thinking about private markets on rolling 1 year. Not a lot changes 3 month to 3 month. So we're doing that. Secondly, and extraordinarily important, these are lagged by a quarter. So these are at the end of December. And as a reminder, at the end of December, the S&P was at its all-time high, and 10-year yields were 100 plus basis points.
good.
Just caveat, as our lawyers have advised us. That being said, the returns are spectacular. So what drove private equity? So markups and realizations, core real estate, a rebound from some of the more, core real estate, you benefited greatly from the portfolio construction. So relative to the benchmark, you had overweights to industrial, to multifamily, and some of the niche strategies. Core real estate driven by a recovery from pandemic lows. Infrastructure, a little bit better than how it's performing, but kind of in line with its historical performance. And again, concentrated portfolio doing as expected. And importantly, it's designed to benefit from rising inflation. So we will get the benefit over the next few quarters to see how that's done. An opportunistic fixed. So the 1-year return is still positive. If we showed you a 3-month return, that's slightly negative. So with a rising rate environment, we expect those returns to come back down again. Importantly, opportunistic fixed is marked as the end of March 31. So that does include that negative first quarter.
So can we talk about that a little bit more? Because I think we're going to have some recommendations in opportunistic fix.
Can you just hang that up?
Or is that going to be dealt with? But I think that's a notable number because that's the first quarter number. And if we look back at what the Barclays Aggregate did, the public market fixed income did significantly different.
Significantly outperformed, yes.
Yes, and that's the logic for opportunistic fixed, which is that it's in public fixed, you're impacted by rising rates, you're impacted by spread tightening or widening. And both of those variables are sort of out of your control. And there's a little bit of value in security selection, but very modest value in security selection. This is all about strategy, finding opportunities in either public or private credit markets. And this is the kind of diversification that I think we're going to be dependent on for some time to come.
And said differently, some uncorrelated strategies that don't just move with public markets. That's the holy grail of allocating.
And that's the logic of this.
And then importantly, the bottom table on this chart, the dark line is your performance over the various time periods listed above, and then the 3 benchmarks that we measure ourselves against. So let's start at the first line, your custom policy return, you underperformed by a full percentage point. That primarily comes from US equities and international developed market equities. Go into that in a second. How have you done versus a public market 65-35 equivalent? So you outperformed that by 110 basis points. That's because your allocation to privates, which have done so well. That same factor hurts you in the Tux. The Tux, as a reminder, is a broader 20 billion and above endowments, foundations, and pensions. And those most of the funds in there have higher allocations to privates than we have, not because of our control, because of other control. So those are the 3 benchmarks that we like to measure ourselves against. And if you look at longer time periods, there's not as much deviation, but the same factors would hold into that. Next slide, please. So importantly, how do we disaggregate the excess returns? On the far right hand, so the excess returns, negative 92 basis points in the middle. That's decomposed into 2 components, the asset allocation effect of plus 9 basis points. And these were the slight overweights we had to cash, the slight underweights to fixed income, the slight underweight to public equity. So that shows up as a rounding error, if you will. The majority of the underperformance came from manager selection. So let's dig into that. Next slide, please. So here are the excess returns for public markets. We're going to show public and then private because they're very different. So US equities, 3-month and 1-year underperformance. And this is unusual given that you are mostly indexed. So you don't expect much deviation. So what's the driver of that? One would be your lack of exposure to energy. Energy in Q1 was up 38%. Energy on a 1-year basis was up 56%. So you're missing some of that. But equally disappointing was the performance of your small cap managers. And with the exception of Pangora, who's a quant manager, the rest of them underperformed. So the two contributing factors, those are the two contributing factors. The world ex-US numbers stick out like a sore thumb. And yeah, two managers responsible for that. On the shorter term basis, on the longer term, there are the reasons that you've outperformed, and they are Bailey Gifford, eye-popping numbers. On a 3-month basis, they underperformed by 1,800 basis points. And on a 1-year basis, 2,200 if memory serves. You know, and
I'm sorry, 1,800 was
a 3-month basis.
3 months.
And then on 1 year, 20, I'm just checking notes. I don't want to misquote you since you're taking notes. 2676 underperformance. And remember what Bailey does. They are the growthiest of the growth. They own Zoom, they own Peloton. You know, they have that's the thesis. That's why we hire them. And they've done great over the long term, but they're caught in this, that collapse of the unprofitable tech index. Walter Scott is the other one who's underperformed. The numbers with Walter Scott, 3-month, 700 basis points underperformance. And on a 1 year, 200 basis points underperformance. They are growth, but quality growth. So they're much more concerned about the fundamentals of a company and near term rather than longer term like Bailey. So those are the contributors to that. In emerging markets, not much deviation, but dispersion within your managers. The growthy managers, Bailey Gifford, UBS Sands, underperformed. And then importantly, Acadian, AQR, who are quant managers, outperformed. So it kind of offset each other, but just important to understand the dispersion that happened there. High yield, Tina's going to cover. ETI, the second to bottom line. As a reminder, your ETI portfolio has a slightly longer duration than the index. What does that mean? In a rising rate environment, we expect them to underperform. In a falling rate environment, we expect them to outperform, and it did as it was supposed to do. Next slide, please.
Mike, before you go on to the next slide, I just wanted to kind of get a sense. So you're talking about like these active managers who are going into growth. And anyone, I mean, I would imagine that if you're into Zoom and we're in the pandemic, right, that's a smart place to be. But as restrictions are easing and as things are returning to normal, would the play be to get out because Zoom can only do so much, right? Like there's only so many more virtual meetings that we aren't already doing, right? And if anything, so what's the logic behind these managers hanging on much longer than it would seem logical to hold on?
Use that one example. Let's go back. We're not out of the pandemic. Let's go back to the end of, when did we get the vaccine announcement? November of 20?
Yeah,
I know, it's
yeah.
hard to remember. So that's when things kind of like, oh my gosh, we might actually emerge from this. And then take Zoom as example. You know, it's been on this massive growth rate, and you're one of these small cap managers who owns it, or you're Bailey and you own it. And I can't speak for them, but the logic would be, okay, massive growth rate, it's going to decelerate to what level? Look, we're still doing virtual. We're still using Zoom, and you know, not exclusively, now we're doing both. And I think there was probably a pretty healthy debate at the time. Is Zoom going to be a permanent part of how we meet? Is business travel going to be curtailed? And you know, because the airline stocks are the opposite of the stay-at-home stocks. And I don't think we knew as a society at the time. And I still want, you know, personally, I wonder if Zoom is a great buy right now. Like,
And if you rode the Peloton while
you get a Peloton for family members. And there's a handful of those pandemic stocks that I think really benefit, the stay-at-home stocks versus the ones that, you know, the travel stocks that were curtailed. And it was a tale of two stories. One gets thrown in the growth category, and one gets thrown in the value category. So that's, but it's a better question for a Bailey to answer. And you know, we certainly have had them, not had them, and we've had them on Zoom and got over this with them.
I'm getting it.
So let's go to privates. Next slide, please. Yes. So again, the caveat with lagged, but some really strong performance. So starting with private equity, 1 year numbers. As a reminder, these are dollar weighted, not time weighted. So there's some difference in the numbers. But the benchmark was 25.6%. That was the Russell 3000 return for on time weighted. I'm sorry, dollar weighted for that 1 year. 74% of your AUM outperformed that 25.6. So really strong performance when you compare apples to apples. Both markups and asset sales benefited to that. Star performers included KKR 12, which is a big weighting in your portfolio, and an eye-popping, low 80s IRR. Other strong performers included Platinum 5, EQT 8, and those are both, again, eye-popping, 65-ish kind of numbers, so really strong. In core real estate, I had mentioned you benefited from portfolio construction. So the managers who really did well there in the logistics section, think the Exeter Core Fund, think Elm Tree, think Lion Trust, they all did well. And then in non-core, the Exeter Industrial Fund did extraordinarily well. KKR Europe Fund did well. The Airmont Fund did well. And again, kind of crazy eye-popping, 50-ish% numbers that aren't going to hold at that level, but they are what they are for the time being. Infrastructure, again, strong outperformance relative to its, both absolute to its relative benchmark. And two managers, KKR and EQT, benefited from, they both had two asset sales within their portfolio that were meaningfully higher than where they were marked and higher than what they'd underwritten them to. So really strong performance by a couple managers there. An opportunistic fixed, I'm going to defer and let Tina go into greater detail on that. Next slide, please. So in terms of rebalancing in Q1, what did we do on your behalf? You see $2.25 billion in and out of your portfolio. $1.7 billion of that had to do with funding 3 new mid-cap managers for you, and those were Cook and Beeler, Victory, and Westfield. The only rebalancing flow was $550 million that came out of the U.S. equity market early in Q1 as we were reducing the overweight while the market was still low. Other than that, there's been no rebalancing activity on your behalf. Next slide, please. And this is the summary of your overweights and underweights. Again, we try and show you a little time series, how that's evolved over the previous 3 quarters, as well as what your policy targets are. So if you look at Q4 to Q1, what's changed? Cash went up a little bit. The next 3 rows are all about fixed income. No meaningful change there. We maintain those slight underweights. And then in the 3 sleeves of equities, you can see that was in aggregate a slight overweight has now turned into an aggregate slight underweight. And importantly, the movement in emerging markets happened through changes in NAV, no activity on our part. Again, the only activity that we did was that small $550 million piece in Q1. So that kind of concludes Q1 from my perspective. And I think we go into Dan, who's going to do some risk analytics around that, unless there's any additional questions, comments, concerns on Q1.
Any questions for Mike?
Okay, Dan, over to you.
Great, thanks, Mike. Everyone hear me okay?
Sure. You're a little bit faint, Dan, so maybe a little closer to the.
A little closer to the mic?
Yes.
Okay. Well, good morning, everyone. I'm here with your new Chief Risk Officer, Ed Berman. Hiding.
We can't afford 2 Zoom licenses.
He's hiding just off screen with a notepad and some support for me. We're going to review some highlights again, as before, of the risk summary that appears in your quarterly reports. Again, as usual, starting with the top left corner there, you can see that the total plan risk for the quarter ended March 31st was 10.95%. That's up from 10.59% back in December. The benchmark risk is also 10.95% in March. That's increasing from 10.33% in December. Benchmark risk increased a little bit more than portfolio risk, and we see small corresponding changes in your active risk and portfolio beta numbers. If we move to the bottom panel, again, this is your ex-ante portfolio risk. That's the blue line, the benchmark risk, your red line, and portfolio beta, those gray bars that correspond to the right-hand scale there for each of the last 12 months. And again, wanted to show you the trends in the portfolio, in your risk over time with this section. You can see, of course, as markets became a bit more volatile in March, your overall risk, increased slightly. This is, again, forward-looking risk, so it's modeled through bar 1. It's your ex-ante risk. Let's see here. The chart at the top right breaks down that change in risk during the quarter into 3 broad categories. This is the change in volatility, your change in correlations, and the change in portfolio exposures. The change in volatility and the change in correlations categories are market-driven phenomena. So these risks decline and changed in step with market risks and were not the result of specific position rates or tilts in the portfolio. And then the change in portfolio exposures, that bottom line there, represents the portion of the portfolio risk that's detached from those market trends. You can see again, most of the change in risk in your portfolio for the quarter had to do with the change in volatility. So again, markets became more volatile, as did the portfolio. And that's what drove most of your risk up. And that's a bit of a change from quarters past when we examine the same metrics. And then finally, of course, the table at the top center there shows you the differences between your portfolio allocation by assets and your allocation to risk. Again, the headline here, we're about a 60-40 split between equity and fixed income in terms of allocation. That allocation, you're deriving 95% of your portfolio risk from your allocation to equity. Just meaning that equity drives most of the risk in your portfolio. We can take a look at this in a little bit more detail in the next slide. Thanks, Kate. Okay, here we're summarizing your portfolio allocations, your performance and your risk by strategy, again, for the quarter ended in March. Actually, we're using a 1-year look back here. The leftmost section, you're seeing a snapshot of your parking place adjusted allocations on March 31st. This is echoing the slide that Mike shared with you a few minutes ago. Again, at that time, we had slight overweights to cash and were underweight our core fixed income strategies. The performance section in the center shows you the 1-year return by strategy relative to their benchmarks, again, echoing some of the slides that Mike shared with you. Here we see the alternatives outperforming their benchmarks, as we talked about. And then we have the underperforming developed markets equity. And then finally, that last section, we're decomposing the risk by strategy. The first 3 columns in that section show you the benchmark risk, the portfolio risk, the benchmark risk, and then the contribution to overall risk for those for the portfolio. Again, harking back to the last slide, about 2/3 of the 95% of the overall risk comes from your equity strategies, but you can see it broken down here. Also interesting to note that about 2/3 of the way down, you see the core fixed income strategy is a slight detractor from risk at negative 0.1%. And that's due to the strategy's slight negative correlation to the rest of the portfolio. I think we saw that last quarter as well. And then finally, that rightmost column, we're showing the active risk or the tracking error in the portfolio. Again, I think we mentioned this last quarter, but for context, you'd see very little tracking error coming from a pure passive portfolio. You'd see maybe 1 or 2% coming from an enhanced index fund, like a smart beta strategy. And then you see something perhaps about 4% for actively managed funds. Along those lines, you note that the tracking error is comparatively low if you were comparing U.S. equities, which are largely passive, to say emerging markets, which are more actively managed. Finally, as in quarters past, we also see that the tracking error, much of the tracking error is picked up through alternative investments. And again, that's a function of the alternative methods themselves are modeled through Borrow One, through the risk system. And they don't necessarily, the performance indices that we've assigned to them as a matter of policy don't track the risk exposure, within those modeled asset classes particularly well. So again, perennially, we pick up a lot of tracking error for those. It's just a matter of construction, but they're relatively stable over time. I think that covers the highlights of the quarter. I think I'll turn it back over to Mike. We can start exploring some more recent trends in the portfolio, or if you have any questions, happy to answer them now.
Questions for Sam? Nope, we're good.
Okay. Thanks.
So let's talk about concerns going forward. And the concerns going forward are similar to what we've experienced, and that is slowing growth, high inflation, and rate hikes. On top of that, the geopolitical concerns still remain today. As to the Russia-Ukraine war, when you talk to the so-called experts, there doesn't appear any easy way out of this for either side. So we expect those concerns to continue. In China, a lot of uncertainty there, but the zero COVID policy certainly adds to supply chain issues. It slows growth. The property sector decline, they're still going through that issue and this whole shared prosperity policies. Next slide, please. So let's dig in a little bit into the slowing growth and high inflation. So what do we expect? What's going on? We have central bank hikes. We have the Fed about to embark on QE. Europe is about to end, QT. Europe's about to end QE. And we still have this high inflation rate that is expected to kind of be sticky near term and then come down later. The big question of recession or soft landing has important implications for the asset class. And we're going to try and frame that through two different ways: neutral or restrictive monetary policy, and then financial conditions index. So let me try and lay out. Let me back up to QT 1 second, because, and Robert's going to talk about it, but I want to frame this in a historical way as well. What was passed in this country was almost $5 trillion during the pandemic, with a T.
Real money.
Yeah, never done that before. What does that mean? That stimulates growth, causes the government has to borrow more money to do that. So borrowing requirements soared, but at the same time, the Fed embarked on QE. Lo and behold, the size of QE matched the size of the increased borrowing.
Can I ask a question? As a newbie, what is QE and what is QT?
Quantitative easing and quantitative tightening. This is when the central bank buys securities in the market, and they're trying to influence the economy through this. So all that so the Fed bought everything additional issued by the Treasury. Some people might call this modern monetary theory. Some people might call this monetary fiscal link. Whatever it was extraordinary, and it's now ended. In little terms, month by month, the Fed is lowering the amount they're buying, and their balance sheet is shrinking. And in the simple principles of supply and demand, if there's less demand for a given security, what has to happen? The price has to be lower. So all things being equal, rates should continue higher. The other thing, and I'm going to go back to neutral restrictive policy. What does that mean? Neutral policy in economic speak is R star. What is R star? It's a policy rate that neither stimulates nor slows the economy. It's this perfect setting that the Fed tries to get. Restrictive means when they raise rates enough to purposely slow the economy, what happens during then? Unemployment goes up, earnings go down, and they're intentionally slowing the economy to get inflation down. And one of the key questions for markets is which one is required to get inflation down? And that is, as inflation falls and short rates go up, where do they get to the point where it neither stimulates, where it gets inflation down? And that's obviously not knowable. We're going to spend some time on that. I just kind of wanted to set that up. Next slide, please. So growth is extraordinarily important to, I'm sorry, let me set this up. This is change in growth and change in inflation, a consensus of how it's evolved over the past year. The light blue line is inflation. So you can see how, as it's gone up, expectations have gone up. We've gone from this transitory to some other word that we're using now. While growth forecasts have come down as well. Next slide, please. Why does GDP growth matter so much? It is the single most important factor that drives earnings in the equity market. And what this slide shows is just the tight fit between earnings and growth. So as growth goes, so do earnings, and so does the equity market. It is the single most important factor. Next slide, please. So how does recession impact the equity market? What this slide shows is the last 12 recessions since the end of World War II. The dotted blue line across shows the median peak to trough decline in the S&P 500. As you can see, that median in history is about 24%. As of this morning, we're only down 14% because we had a nice rally in May. So relative to history, we haven't really gone to a recession. The other thing I'd point on this is the dispersion between the worst peak to trough drawdown, which was the global financial crisis, and some of the lighter ones. So this question of recession or soft landing, important impact on the equity market. And recession or soft landing is going to be driven by neutral or restrictive policy.
So, and if it's not the appropriate time to ask this, you can get to it at the end. So then how are like Jamie Dimon's remarks from yesterday about a hurricane? Like, how does that, is that just, because he's a big mouth, so he, you know, people, the words from him will shift the markets and shift the outlook, right? So is that going to have any real effect, or is he just pontificating?
I think he's pontificating, but from a wealth of information. You think about the touch points of that institution, they see a lot through their various businesses. And it's funny, a week ago, he was giving calming remarks. So I don't know what, and I didn't delve into them, but if you think hurricanes is a chosen word, but you know, it's the exogenous shocks, you know, the Russia situation, the China situation, you know, the things going on in our country, the division within our country, the left versus the right, these are hurricane-like factors. And we're facing higher inflation, which means interest rates are going to be higher for the next probably decade than we've seen in the past decade. And that's not great for asset markets. You know, we've benefited, those high PE ratios, we've benefited because we've had low interest rates. And I think some of that hurricane is that those higher interest rates going forward.
Can I just, so the higher interest rates, I think it's important to note that they're not great for equity market valuations, but they're good for, we have a big fixed income portfolio. And so we'll have some shorter term pain as market values fall, but we'll be reinvesting at higher rates. Right. Not all that.
Tom, did you have a question?
No. Soft landing or recession, what can we expect? Is there a time frame? Or what? You're saying recession or soft landing?
I think that the appropriate time frame is probably somewhere between a year to 18 months to 3 years out. There's a lot of momentum in the economy still. Q1 was a negative GDP quarter, but that was because of the net trade drug lowered the market meaningfully. Thank you.
Sorry.
Talking to the teachers, I should know better. But consumption is 2/3 of our economy, and it remains strong in Q1. It's remained strong into Q2. There's $2 trillion of excess savings in our economy from folks saving, as well as that $5 trillion of stimulus, and job growth still remains strong. You know, so there's a lot of positive things going on that would, and there's no distress in the credit markets that would signal we're nowhere near a recession right now.
Recession or soft landing, it can't be anything else. It can't like all of a sudden miraculously change. Something that you didn't anticipate. And
so it's funny because so Dan's gonna do a stress test around these, and he was like, aren't you gonna give the good scenario? And I'm like, what is the good scenario? Like Putin ends the war, China ends their zero COVID. Yeah, that would be a good scenario.
Sorry.
As a matter of fact, yes. Yeah.
And if that's a good, if a good scenario happens, then all of
And it
worries.
wouldn't be a soft landing or a recession.
It would be continued strong growth,
So,
and somehow inflation miraculously comes down, and Santa Claus is real.
I left out the last.
A little snarky.
But let me say,
Snarky.
but if we continue strong growth, then you would not think inflation would come down, which then means the interest rate channel has to work harder to slow things down to get inflation down. So the really good outcome is somehow growth remains above trend and inflation comes all the way back down to 2% from the high sixes. It's possible. That supply side stuff gets worked out. And I have a good graphic on that I'll share in a second. So it's possible. I just think it's, you know, to me, investing is risk, reward, and probability. So a good outcome, that's gonna be great for the portfolio. What's the probability of that?
Guess you also live in Santa Claus.
Next slide, please. You're gonna use that on me for a long time. So when we think about inflation, fundamentals around inflation, two slides to share with you here. On the left, this shows within the graph, there's a bunch of different things listed, starting with new cars. These are the items that have been impacted meaningfully by the supply constraints around the world. And what the black line in the graph, the black line graph, is the sum of all those inputs onto year-over-year core inflation. So you can see at peak, it was adding about 150 basis points to core inflation. And as these supply kinks get worked out, we expect those numbers to come down. They've started to come down slowly. This graph is a month or two old. And importantly, this is a Goldman graph. They see it contributing less over time and then actually taking inflation lower over time. So if and when this comes to fruition, this is very positive for the supply part of, I'm sorry, the goods part of inflation. And these things have been impacted. You know, you're going through it now, trying to buy a used car. I mean, it's real. Unfortunately, on the right side, I'm showing, I'm calling it OER. In CPI speak, that's owner's equivalent rent. It's what the Bureau of Labor and Statistics tries to estimate home cost of living for living in your home. And what the model on here shows is the dark line is the model, and it's forecasted to go higher. Where that X is where we are now. Key inputs into the market are some rental indices that are more real-time, home prices. The theory is that rent prices follow home prices over time, and we know home prices are up 20% year over year. So, and OER is about 1/3 of total core inflation. So while we have inputs on the left are going to push core down, we have inputs on the right are going to push service sector inflation higher. And if you divide our economy into goods versus services, we're like 2/3 services, 1/3 goods. And if you looked at trend goods, where is demand? It's up here relative to trend line, exacerbated by the supply shortages. If you look at trend services, we're down here because a lot of these have been impacted by the pandemic. You know, think travel, think all sorts of different things. And as we reopen, those are going to come back up again. And I think for anyone who's flown or has booked an airline ticket, you know, you feel the change in prices. That's going to be rising inputs to inflation. Next slide, please. Inflation is also important to think about the labor market. If you go back to the 70s, what was the vicious cycle? We had higher labor costs and higher inflationary costs, and they spiraled and they led to one another. That's what the Fed desperately wants to avoid. That's why they need to slow the economy. So how do we measure inflation in the labor market? Two different graphs on this slide. On the left, widely regarded a good index is the Atlanta Fed wage index. And it's up around 6% now, and you can see, you know, going back over the past 25 years, we're at new highs in wage price inflation, and that doesn't appear to change, because on the right, what we're showing is this is from the JOLT series, job openings versus the number of unemployed, and that gap is almost 2-to-1 of job openings versus unemployed folks. So if you think there's that much more demand for labor, again, principles of supply and demand. If demand is up, then the cost of it's got to go up as well. So the fundamentals in the labor market look to be continued inflation. Again, that's why the Fed needs to raise rates. They're doing it with two blunt tools, rate hikes and QT. And where they get to that changes these is the big mystery that we face. Next slide, please. So how do we think about inflation globally? This graph came out of the FT, and it's for each country, there's 4 different bars. The first 3 bars are actual inflation forecast, actual inflation over the past 3 years. And you can see the spikes everywhere.
Which is that bar?
The dark bar is April of 22. Yes, 1 year
That's
trailing
actual.
inflation. Yes. This doesn't include what got released earlier this week. So European inflation is even higher than what's on these bars. The red bar is a consensus forecast for the remainder of the year. So the good news is you expect to see inflation to come down and a little bit. And this restrictive neutral thing gets down to the pace of the decline versus the path of the rate hikes. And when do they slow things enough? Next slide, please. One more slide on inflation. Inflation also, expectations of inflation are important for consumers' mindset. So the theory would go, if you think airfares are going up in the future, you're more likely to book now and lock in the price. If you think airfares are going to go down, you're going to wait. And that mindset tends to spiral on one another. A lot of different ways to measure inflation expectations. This comes from the New York Fed. The white line is 1 year ahead consumer inflation expectations, the blue line 3 year, the orange line 5 year. So this is calming. What this would suggest is consumers are experiencing high inflation now, but they expect it to come down in the future. So long-term purchases, they don't feel a rush to go out and consume now, and they're going to wait. So this gives the Fed more calm than anxiety. Next slide, please. So this gets back to the neutral or restrictive, and I'm trying to frame this a little bit more clearly. On the left-hand side, there's 2 different lines. This is the real funds rate as defined as the funds rate minus CPI. And the dark line is headline CPI, the light line is core CPI. And so these are the actual rates that exist today. This is not what's discounted into markets. So headline CPI is minus, I think it's like -7 now, because inflation 7.5, the funds rate is 0.75%. Most market participants think neutral is somewhere where those two come together, where they're around 0. Restrictive is something greater than 0. So again, the decline in the inflation rate, the rise of the funds rate, if they can meet around 3%, we get a soft landing. And importantly, what's priced in markets is on the right-hand side. That is the June 23 Fed funds futures contract, which is which is the market indicator of what the market is expecting for Fed funds in June of 23, which is the peak in rate hikes that's priced in. And the contract works, it's 1 minus the scale on the right. Said differently, 97, the figure where the bar on the right is around a 3% funds rate. So the market is expecting the funds rate to get to 3% by June of 23. And the market feels that that's sufficient to slow the economy. And if all this comes to fruition, then pardon me, these 2 lines should come up to around 0. The inflation rate will be around 3. The funds rate will be around 3. 0 real funds rate, and that's the soft landing that markets are optimistic and hoping for. Okay, now here comes the bad news. Next slide, please.
You never put me in your head.
Oh, I'm sorry, financial conditions index. The other way to frame this, moving the federal funds rate, doing quantitative tightening are blunt instruments. And how do they slow the economy? So the theory would be they slow the economy through the impacts through various channels of the market. So this is, again, the Goldman Financial Conditions Index. This incorporates 4 factors into it. So the equity markets, short and long-term interest rates, the value of the dollar, and credit spreads. So the lower the line is on the right, the more stimulative financial conditions index is, the higher it is, the more restrictive that it is. And again, the theory is that monetary policy works through channels of the markets, and that is reflective of what's going to happen in the economy with some kind of lag. So where are we now? That's where the bar on the right shows. So judging just the level, you have to look back in time. And what I would point to is here we were pre-pandemic, and we need to be above that level to slow the economy enough to get inflation down. So if you would, just some simple observations, we're probably, FCI is probably not restrictive enough to slow the economy enough to get it down. So how do you get there? Through some combination of those four factors. You got to get the equity market lower, you got to get long or short rates higher, you have to get the value stronger, or you have to get credit spreads wider. And it's how those markets move together that moves that index that will help shape the economy going forward. So the Fed doesn't target markets, it targets the economy, but they work through markets to achieve their needs. Next slide, please. So these next two slides are the ones that personally keep me up at night. So this is a long-term chart back to 1900, and it shows a few different things. So the dark blue line is the Shiller Price Earnings Index, and that's a 10-year index. So that's a long-term view of price versus earnings, inflation adjusted. And importantly, how does the Shiller PE compare now versus history? And the top is expensive, obviously. So you can see on a PE basis, we're still very expensive relative to history. The orange line is 10-year yields. And though we're up a lot from the lows of the pandemic, how are we historically? We're still very low interest rates. The blue, the blue line underneath is the average, and you can see again is the average of those two indicators. We're very expensive relative to history. If history is going to be a predictor of the future, that's good. No, we're expensive.
No, we're expensive. So what that dark blue line is saying, that for every dollar of earnings that you're buying in a public stock, you're paying a historically expensive price.
So then it needs to go up even more.
No, it needs to go down.
So the theory, most of this theory, everything that underlines this is that there's a long-term equilibrium and things average over time back to that long-term equilibrium. And that's what has happened historically over reasonably long periods of time. So if you're very high, you're going to move down to average back to that equilibrium. And if you're very low, that is really the fundamental tenet of everything we're talking about here. If you're way above historical averages, the likelihood is you're going to come down to meet that long-term average. If you're very low relative to historical averages, likelihood is you're going to move up. And what this is saying is that the market is still historically expensive, despite the fact that it's down 13% year to date. Still expensive, because remember, we've been looking at this 10-year period of time of absurdly high returns.
Yes.
And the problem, this is my joke, but the problem is you're seeing that in private equity. Private equity is just leveraged public equity. And so we've had great returns across the board in our equity portfolio, and we just can't expect that. We've been saying this for years, and we knew we would be right at some point. And so now we're right. Things are going to trend down to meet the long-term historical averages. You just don't know at what pace or how long it will take. That's all you don't know. It will happen, just don't know how it will happen.
I always know it would happen.
Yeah, but if you don't know when it's going to happen, there's nothing to do about it. That's the problem.
Let's flip to the next one because it kind of captures it. Okay, can we go to the next slide, please? So again, 120-year chart. And what this shows is 4 different episodes of a lost decade of returns for an index portfolio. So this is historical. So the financial bubbles is the one labeled 2000, 2010. That 10-year period captured both the NASDAQ crash and the GFC. So there was a long period of time when the equity market on a 10-year basis returned nothing. So the last 10 years we've returned, I don't know, 15% on average. That time period we returned zero. And
What was that?
between 2000 and starting in 2000, starting in 2003, any of those 10-year periods, so 2000 to 10, 01 to 11, 12 to 02 to 12, those were all zero returns for the equity market because they captured those two drawdowns. And you can see the labels for the other times of history that's happened. But the other takeaway from this graph is those lost decades took place after very strong run-ups. So exactly to Robin's point, you get these run-ups and then you go sideways for a while. And that's, when you think about our portfolio with a lot of exposure, to both public and private, are we in one of these scenarios where inflation is going to be higher than expected, interest rates going to remain high, which then suppresses values? And, again, this is historical. Maybe we don't experience it, maybe we do, but it's just to share with you that we had one of these periods not that long ago, and we've had a few of them over history. Now, if we get when Santa Claus brings me my new toy truck and inflation falls and growth stays strong, well, we're still up and to the right.
You actually wrote a list.
In case I'm wrong. So then Dan is going to do a stress test on your portfolio around this recession.
Stress test on us or? We're ready for one.
The quiz comes at the end of the lecture. That. Let me turn it over to you, Dan.
All right, thanks, Mike. So again, we have three stress scenarios for you this quarter. Again, we're attempting to frame the market's reaction function to a lower growth inflationary environment. As in the past, this is meant to be a sort of a thought experiment that frames the direction and general magnitude of those market responses to some broad macro inputs. As I mentioned, of course, we've got three scenarios here. We started with MSCI research that they published back in April, and then Ed in particular had some really informed thoughts on how we could modify that to just reflect more recent trends and that we've seen since then, because the world has changed quite a lot in the last month. Just looking at the cases themselves, we have this base case scenario that we see as quite a likely outcome, where we're assuming here that the Federal Reserve is successful in guiding the economy to a gentle slowdown. GDP growth is slowing with a possible quarter or two of negative growth. We see inflation moderating, leading to the bull steepening of the curve. Equity markets are soft, and then you see some pressure in credit spreads. This scenario, again, base case, we're assuming no negative geopolitical shocks. The next one over, we labeled recession. That's our negative scenario, a less likely, but still a significant outcome, and certainly worth paying attention to. Here, markets are entering a prolonged recession. Possible negative shocks could include a Fed policy mistake, enhanced geopolitical risks, some new negative news kind of enters our conscious, reemerges of COVID perhaps, or even further tightening in China. Under this scenario, inflation is accelerating, driven by supply, which leads to a bear flattening and negative pressure on the stock market. We see credit spreads widen and commodities rally under this scenario. And then finally, Christmas comes early, and we have our positive surprise. Perhaps the least likely of all three of these outcomes, but this could be driven by surprises like China, removing COVID restrictions or providing, some form of fiscal or monetary stimulus, or maybe the successful resolution of the Russia-Ukraine war. Again, the concept behind this is that the world starts trading again. Oil flows freely, our supply chains are those constraints are removed, and supply chains free up a little bit. So it's a risk-on environment. We see under the scenario inflation receding due to this easing of the supply lines and increased supply of commodities. You have asset pricing rally here. The rate curve steepens a bit. Credit spreads tighten and commodity prices would decline here. And then given these assumptions, we can see the results on the next page. Thanks. Here we're showing the predicted returns as before of the scenarios for both the overall portfolio and then selected strategies within that portfolio. Each scenario is represented by a different colored bar, and then the magnitude, of course, plotted along the horizontal axis there. At the portfolio level, you can see that the results range from an 8.6% increase under that positive surprise scenario to a 14.1% further decline in the recession scenario. In these negative scenarios, you can see that our more defensive strategies like TIPS and core fixed income mitigating losses. And then you may also note that international markets tend to sell off a bit more extremely than the US as they're historically more volatile. Similarly, you see private equity showing sharper declines. Again, this is a function of how private equity is modeled in bar 1. Which is an important concept here. A model, particularly like that, it's forward-looking, but it's naive to the speed of recovery from a shock. A model can't speak to the skill of our managers in beating the market or successfully navigating a challenging environment. As an example, I guess, if we were thinking about how private equity responded in a V-shaped recovery like we saw in COVID, we see the private equity actually performed quite well despite a big negative prediction that you'd see in the model. It's because the fundamental valuation metrics never suffered much and the portfolio response to the macroeconomic stressors was muted. However, to the extent that these macroeconomic headwinds persist, the model expects more extreme valuation pressures over the longer time frames. And that, of course, certainly lends credence to the lost decade idea that Mike shared with you a few minutes ago. So I'll leave you with that wonderful news. Happy to take any questions you may have now, or we can move on to, I think, executive session and talk about more recent trends in the portfolios.
Questions for Dan? No. Thank you.
Thank you.
Great, thank you.
We'd like to go to executive session.
Sure. Okay, so we're going to do executive of pension funds and then have, so, okay. All right, so we are ready to go into executive session. Do I hear a motion to go into executive session?
So moved.
Thank you, Mr. Brown. Do I hear a second? Second. Thank you, Mrs. Hirsch. All those, any questions? All those in favor, please say aye.
Aye.
All those opposed? Abstentions? We are going to executive session. Okay, we are back in public session. Ms. Sang, would you like to report out?
Certainly. In executive session, we received additional commentary on quarterly fund performance. We received 2 OFI presentations. Consensus was reached on both. We received 3 presentations on real estate investments. Consensus was reached on all 3. And we discussed the renewal of several investment manager contracts and the contracts for our commission recapture brokers. Consensus was reached.
Thank you so much. Does anyone have anything else for public session for this investment meeting? Hearing none, do I hear a motion to adjourn?
So moved.
Thank you, Mr. Brown. Do I have a second? Second. Thank you, Ms. Hirsch. Any discussion? All those in favor, please say aye.
Aye.
All right.
Aye.
Any opposed? Any abstentions? Anyone want to stay a little bit longer?
So moved.
All right. Hey, everyone. Thank you, y'all, for your fingers must be
Everybody.
cramping up.